All right.
Welcome to the first of our 2025 Market Pulse podcasts. I'm your host, Maria Urtubey, member of the Equifax Advisory Team. As a group, we identify economic considerations and leverage data and analytics to translate into industry insights. This helps us make recommendations to support our customers during economic uncertainty and to uncover growth opportunities in the consumer credit risk space. I am pleased to welcome our panel of experts, Emmeline Aliff, Dave Soika, Tom O'Neill, and Jesse Hardin. Welcome back.
Hey,
Thanks, Maria. Glad
Hey
to
there,
be back.
Maria. Welcome
Good
to
to be back.
2025.
Following the December Looking Back at our 2024 Predictions podcast, in this episode, we get a chance to redeem ourselves, or at least start on a clean slate, 2 weeks into the new year or so. Before we dive into the conversation, though, economist Justin Bagley from Moody's Analytics is here to share the current macroeconomic overview.
The U.S. labor market continues to run full steam ahead. In December, firms added 256,000 new payrolls, the strongest monthly gain since March and besting most forecasts. Once again, the mix of industries adding jobs was unsurprising. Healthcare and leisure and hospitality remained the primary drivers of new jobs, while manufacturing's slide continued. December's upside surprise closed the books on yet another strong year for the labor market. Payrolls ended 2024 with 2.23 million more jobs than in 2023. And while this marks a slowdown from 2023's 3 million job gain, it aligns with the average annual pace in the 3 years preceding the pandemic recession, suggesting that the labor market remains on solid footing. The labor market will be starting 2025 in greater balance. The excess demand for labor that characterized the post-pandemic economy has largely abated. Declining job openings coupled with robust labor force gains from the recent surge in immigration worked to loosen the labor market through 2024 as firms that were previously starving for workers were able to fill many open positions. As a result, there were just more than one job opening for every unemployed person in November, down from more than 2 vacancies for every unemployed person at its peak in March 2022. The economy is generally in a good place, and small businesses, which account for about half of all jobs, are finally feeling it. Small business confidence has come back with a fury since the November election. In December, the NFIB Small Business Optimism Index jumped to its highest in 6 years. Main Street's outlook for the economy over the next 6 months surged to a more than 2-decade high, leading December's headline gain. Boosting their confidence that the economy will improve near term is the expectation that deregulation and lower taxes will help boost economic growth in the next presidential administration. However, uncertainty on Main Street remains above average as small firms are on the edge of their seats awaiting more clarity about the scope and scale of Trump's promised tariffs and deportations, which could result in higher input and labor costs.
Thank you, Justin. The U.S. economy has been navigating a complex mix of challenges and course correction over the last year, and it's not surprising to hear 25 is envisioned as a year of adjustment and of measured adaptation, particularly with the upcoming change in administration. Inflation is expected to stabilize, bringing further relief to consumers, but prices for some goods may continue an upward trend, particularly those affected by tariffs. The housing market is cooling, but the affordability crisis continues, with mortgage interest rates roaming 7% on already high housing prices. There are a few sticky economic themes from 2024 we identified affecting the U.S. consumer this year and our predictions for 2025. So let's dive in. Emmeline, one of these being tariffs and prices addressed by Dr. Rob Westcott during Market Pulse. Would you share your thoughts with the larger audience on this topic?
Yeah, definitely. Thank you for the opportunity. I love chatting with everyone. So as we talked with many economists around this topic as well as our own perspective. on understanding what are some of the biggest impacts potentially to inflation in the coming year. One of those will be tariffs. And if we think about tariffs, President-elect Trump described tariff as one of the most beautiful words in the dictionary. But what does that really mean? And the standpoints of a tariff is the taxation of goods coming in from an import-based status that that companies can leverage to build whatever they're creating. And so there's different impacts that it can have downstream depending on how those are applied and how that occurs, especially depending on where the source of that those things are coming in from. And so they're depending on where things land from a tariff standpoint, it's either could be a negative GDP impact or inflation of some kind. And so if we think about the various ways that could occur in discussions with Keybridge, they describe three different levels of that potentially occurring as posturing, light implementation, or heavy implementation. And if we consider a posturing perspective, it's like threatening the tariffs, with implementation being slightly low, with a little bit more targeted perspective towards China. And then a light implementation would be a 10% across the board and 60% against China. And a heavy implementation would be 20% across the board and upwards 600 to 200% against China. Now, there's different impacts that can have. For example, if it's just posturing, it does create a perspective that there needs to be less adherence to certain supply chains from depending on where those tariffs could potentially go, and potentially even building out some things more so in the United States. But that's a longer term perspective. So there likely would be, if it moves towards a more heavy implementation, a negative GDP impact that could be fairly significant and resulting in some form of recessionary period. And then also, in addition to that, the inflation that could occur if there's not any change to address the increases in prices that the consumer would bear.
Yeah, Emily, and I think it's interesting that even in your description of, say, the light implementation, I think it's interesting to look at how that impact would be felt. It's not that we'd see, homogenous, increases in prices across the board. A lot of people might not feel any change depending upon what's being tariffed and what is, what those consumers are looking to buy, where others may feel a deep gouge. So it'll be interesting to see how the implementation of it comes out, not just in terms of sheer volume and size of the tariffs, but where those tariffs are. And not just by country, but by industry, by sector, by consumer goods or industrial goods and whatnot.
I hear both of what you're saying. I think the most interesting thing, though, to me is there was talk last week of now having an external revenue service. So internal revenue service collects for internal taxes. External revenue service is going to collect these tariffs, and just made me wonder. So do we implement the external revenue service and then DOGE turns right around and cuts it? That's what's interesting to me.
Well, I'll pull on your Doge thread. Will the tax form be simpler for the external revenue service as opposed to the internal one?
Yeah, that's the question.
All great.
And we're not
questions.
even touching on the retaliation or the effects on foreign policy, right? Since we're keeping it domestic. But
yeah.
Very good point, Maria. Yep.
Yeah.
So
And relating to foreign policy, I know, Dave, you've been sharing with us immigration reform expectations, key focus for incoming President Trump. What are you expecting on this front in 2025?
Yeah, thanks, Maria. So, there's that initial reaction to President Trump's statement around mass deportation. And I'll go back to what Emily just talked about, posturing. So is it posturing? So are we really going to see mass deportation? Or is there a more nuanced approach where border security is addressed, but there's still that welcoming of highly skilled workers that allow the U.S. economy to thrive? I recently read a paper, I think it was a couple of days ago, from the Economic Innovation Group. And it really went into kind of the nuance around the highly skilled worker and the benefits to the U.S. economy, in terms of even seeing faster and higher wage growth for native-born citizens and actually improving the deficit. We're not going to belabor whether that's an accurate statement or not. I know I've seen Lindsay, sorry, there was an article in the Journal from one of our sitting senators around immigration and addressing some of the negatives, but the positive was around the H-1B visa program and how important that is. And so, and actually kind of extolling an expansion, a streamlining, if you will, to increase the amount of visas that we currently accept.
Dave, the thing that strikes me about this whole topic, I like that you mentioned sort of the positive, the H1 level, visa. But I think on the other end of the spectrum, you have, the consequences of the impacts on labor, essentially. And Maria, you mentioned the stickiness of the affordability, theme that we've been struggling with for a couple of years now, and continue to struggle well into 2025. Deportations on any scale are going to just exacerbate that. If you think about the costs of a lot of what people are complaining about the price of eggs now, that's not going to help.
Yeah, agriculture, services.
Mm-hmm.
Yeah,
I think
that's one of my biggest concerns is around the farming side. If we're because the
yeah.
price of eggs has been such a heavy topic with the heavy percent, was it up 40 something, 50 something percent of farm workers are believed to have some form of undocumented nature. So it just becomes a little tricky, and absolutely immigration reform is something that does need to occur.
Yeah.
It's also when you look too at Emily, the format that you kind of put on tariffs. I mean, we do think about the notion that there is a lot of posturing here as well. The question is there strength in posturing above and beyond than the capability of actually implementing what we've heard the administration say. So it will be interesting to see how closely the threat follows to the action.
Yeah. So to kind of take these points and kind of to bring it home is really, I'll address kind of where I think the impact might be felt on the U.S. average U.S. citizen side or the consumer, as we try to avoid to classify all Americans. So is there confidence? People are wondering, can I stay in this country? Businesses, Emmeline, as you just talked about, agriculture, even on the housing side, a lot of the work that's done in those industries is really on um, the potentially, illegal immigrant population. Um, so we have a housing shortage. We need more houses built, and yet we potentially have a damage or a shock to the workers that would facilitate building more houses. And so, there's a lot to really think about with that impact, on consumers as well as businesses. So, where we go remains to be seen.
Thank you, Dave. And maybe bringing it back to the domestic scenario, Jesse, you highlighted rate cuts in your predictions last year. What are you expecting for this year?
Yeah, thanks, Maria. I probably should say that I'm expecting, something just to leave it really vague, but
Way to go out on a limb there, Jesse.
that's right, right?
Yeah.
It will either change or not. Yeah.
Yeah, they will change.
There is a glass.
No, I think, 2025, I personally, I feel like it's going to be a good year. Certainly, I think we're still seeing growth in the economy. We're seeing job creation, good wage gains, low unemployment, falling prices. So that's all the good stuff. I think what's going to happen is when you think of Fed policy, the Fed monetary policy is really going to follow what those numbers say. But then we also have kind of an unexpected component, and those are really obviously hard to forecast. Those are going to be things like a hot read on an economic print that comes through. Think of what we saw last week with the job growth numbers coming in higher. I think we also would expect to see some economic challenge from the things we just talked about. Also things like fire. Think about the fires in the West and the fallout from that, cyber attacks on our banking systems, et cetera. So, we can't really forecast or predict what those unexpected events will do to policy decisions from the Fed. Having said that, though, I think that we saw in 2024 there were significant rate cuts via policy, and maybe more than what some thought. So. As I think to this year, I think we're going to see that at least what my baseline case would be is that we're not going to see any rate cuts. Or if we do, we'll see definitely rate cuts in the longer term. Probably not any rate cuts in the near term. And I think that's just based on the Fed needing to see kind of more data to really get a better sense of true direction.
Hey, Jesse, with the recent jobs and was it the producer price index that came out that
Yeah,
was
PPI.
slightly high, but not lower than expected? You know, does that change, your thoughts on that in terms of has the Fed actually reached its target yet?
Yeah, I mean, I think and we saw the CPI number come out as well yesterday. I think with you can always kind of dissect the report to figure out, based on your predictions, what data is going to support you. I think overall, we're still seeing that prices are moving in the right direction. But I think the Fed's going to be more cautious this year. And I think as a result of that, I don't think we're going to see, broad scale cuts, because the hardest thing to do would then to be turn around and see inflation start to increase again, maybe through these policies that we're talking about. And then the Fed has to react with rate hikes. I mean, with the Biden administration, I can't imagine what the hikes would be, let alone with now the Trump administration, thinking about just the interplay between the Fed and the executive branch. So I think that could also weigh in as well. I think they're going to want to stay more cautious, especially if they want to keep their job.
Yeah, the couple of things that Dave and I just talked about, with respect to price increases and inflation is what drives changes in rates to go higher. And so it really depends on what's going to happen downstream with the other peripheral aspects that would have an impact on prices. And it could impact things from a positive standpoint or negative standpoint with respect to those prices. And I think I really liked how you framed that, Jesse, around a little more cautious, because anytime there is uncertainty, there's less action. And less action. And by some regards, like if we think about these things as being posturing, light, imitation, or heavy, there might even be some form of forced uncertainty to be able to test the waters to see what would be the best pathway forward.
Yeah. And I might close out just by saying, I think in terms of what I'm looking for, then, I'm going to look for things like wage increases. Where are wages this year coming up? Is there more pressure because workers are making more money and they have more options in job switching? I'm also going to look at, what's happening with the credit perspective in the economy with delinquency. So are consumers strong? Are we seeing a higher delinquency that could, potentially ripple through the economy? So kind of also looking at those more consumer impacts in understanding where because the Fed's going to be looking at all that as well. So kind of understanding where their thinking would be.
Thank you, Jesse.
Yes, let me ask you another aspect of that, and maybe this even applies to what Dave and Emmeline also spoke about. But what are your expectations around the impacts on consumer confidence? For any change in rates or lack thereof. Would that be a downward pressure? Do you feel that there's a maybe a sense on the consumer sentiment side that we're in a good place and holding still as you were mentioning or being more
Yeah.
cautious wouldn't necessarily be a disappointment. And I guess the same would hold true for either of the other topics that Emmeline talking about, tariffs and Dave on immigration. If these things hit, is that an area where we could see a pretty sizable change?
Well, I mean, I would say you started out saying consumer confidence, and I would say, I certainly use that as a directional indicator. I don't think, though, that we would see the Fed using something like consumer confidence as a barometer for making a move. And it's simply because there is noise in that data.
Right.
You can actually look at that data, and if you graphed it over the last, 20 to 30 years, you can actually see when elections happen because, there's a bias towards
Sure.
whose party's in power. I do think, though, I mean, overall consumer confidence does indicate kind of the direction that the economy is going. And so, as consumers feel more burdened with things like service level inflation, those numbers just not coming down. I think that's where you're going to see, the Fed taking those types of movements into consideration. Are we seeing wage growth that's maybe beyond what was expected, in which case you're seeing more pressure on those inflation numbers. And same with what Emmeline said with tariffs, and Dave said with immigration. I mean, those are going to be obviously factors that play into overall confidence, and then driving the policy that the Fed is going to put forward.
Thank you, Jesse. And I know we have so much time to address. We still have a hot topic, which is housing. Tom, with U.S. mortgage debt at almost 13 trillion, almost 74% of the total consumer debt as of November of last year, what are you expecting specific to housing in 2025?
Yeah, it's probably appropriate that we have this one following all of the other topics because all of the other topics impact, what the housing market's going to be. And as the father of a child who is looking to make his first housing purchase in the coming months, unfortunately, I can't say that it's a great environment for him to do so. We're still slogging along in the housing department, and it's probably going to continue. The same set of culprits, high housing prices driven predominantly by short inventories, high mortgage rates, making it even more difficult. It's something that's impacting any consumer that's in the home buying market, but particularly the younger generations, for obvious reasons. A lot of the older generations, such as myself, we've been in our homes. We've built up equity in there. Even if we are in the market for a new house, we could use that equity and our savings and the stuff that we've built up over time to help offset some of those higher costs and the overall affordability of going into the housing market. The younger generations don't have that. And they're still wanting to make that first housing purchase. And we've seen in the data that the average mortgage balance for those younger generations is rising at a much higher rate than any other generations, simply because, they're entering the market at a pretty nasty time to be doing so.
I was hearing yesterday, even on the positive side, this is driving alternatives and innovation on the rent to own and the shared housing market. So some, variation of those struggles, right? What are other alternatives might surface, right, as a result?
Yeah, you certainly see the innovation, as people look for alternatives. And I'd love to say that it's a temporary fix until the conditions improve. But as we've been talking about here, there are completely negative. There are some things that might, drive the housing conditions in a better way, including stuff that the incoming administration has mentioned is a priority: tax cuts, easing of regulatory, conditions. Those may, be a positive boost for builders to go out there and take the risk of building more. But on the flip side, it could just as easily have the negative impacts of some of the policies being discussed, some of which we've been talking about here. If we've got, a ding to the labor, availability, that's not going to help, ease the inventory. If we increase, tariffs, you might not associate that directly, but if, increased tariffs have an impact on the materials that go into building, and maintenance of housing, that's going to be felt as well. So, It's definitely I do think that there will be some breaking up of the logjam, but it's still going to be slow.
Yeah, I think, Tom, one of the things I was actually thinking about as a now home purchaser in this environment, I'm actually going through that process as well of selling and buying. Obviously rates are I'm kind of blown away working with mortgage lenders right now, just seeing where the rates are, because my frame of reference was refinancing and the
Yeah,
refinance
we were
boom
spoiled,
after.
weren't we? Yeah.
Yeah, I
Yeah.
mean, I dare to say like I have a one in front of my rate right now, but um, I think one of the things that I kind of think about is the right now the Fed, as I talked about, the Fed had cut rates last year, but we really didn't see any of that translate into movement on rates, and that's has a lot to do with the 10-year treasuries and the premiums
Right.
associated with those. I do hope, as the new administration comes in and maybe things settle a little bit, we'll see that premium, that yield premium, starts to fall, and maybe we do see, we see a reduction in mortgage rates just kind of naturally as the unknown of the new administration starts to work itself out, so that could help as well as we think of, direction, even if we don't see large scale rate decreases from the Fed in 2025, that yield spread being a little bit smaller might help.
Thank you for sharing all those thoughts. Before we close out, I do want to recap similar to the lightning round that Jesse went through with our prediction leveling set for 24. If you could, in a summarized version, share your predictions for 25. Let's get started with you,
I'll
Tom.
go first. Yeah. Oh, do you
Okay,
want Tom to go
Emily.
first? Yeah.
Sure, I'll go first. Yeah, because
He was
I
last.
just sort of I kind of obliquely referred to it as that my safe prediction is that the mortgage market will continue to be the housing market and mortgage market will both be continuing to just sort of slog through 2025. My little more daring prediction will be that Gen Z will continue to have an even bigger mark on its head from the other generations, that they'll be painted as lazy and not moving out of their parents' basements, when in reality it's because they just can't afford to.
Wow. I have a different take, similar to yours. Affordability for sure will be limited, and I don't see the housing market or the help, as you said, towards younger generations going anywhere until prices. It's not so much the interest rate, but prices decrease. And I'm positive or optimistic on the Gen Z. I think they will teach us a lesson. They're way more focused than we envision, and they will surprise us. I think that will.
I share that opinion, Maria. I am optimistic about the generation, regardless of, their attitude towards avocado toast. Yeah.
Look at you, glass half full peoples. I love it.
Emmeline, I
Yeah,
interrupted you.
I personally like avocado toast too, so I take offense to that. No, but I do think
Very
that
Californian.
I do think that affordability will likely be one of the higher challenges because of all the things we talked about, price increases were likely going to be some of the impact that we could potentially see, even with those uncertainties, like whatever uncertainty could happen. But with the affordability, I do think it's going to have some level of nuance associated with it. Specifically, that nuance will likely have a further spreading out of the K-shaped economy we've been talking about, because we know that delinquencies have been on the rise, and auto, for example, is higher at a delinquency level than it was during the Great Recession.
Right.
However, auto delinquencies, when we look at payment hierarchy, it is still at one of the highest likelihood of getting paid. So if someone is moving at a place where they're delinquent on their auto and it's higher than the Great Recession, that means they haven't paid their other debts first. So there's going to be continued separation. So those people who have been able to invest in the stock market, who have who have like a home, who have all those things, who have the financial literacy, will continue to thrive. Where those consumers who have been struggling may struggle more.
Thank you. Dave or Jesse?
All right, I'll go.
Okay,
I'm
go
gonna
ahead,
go.
Dave. I'll
I'm gonna
close
go.
this out.
Because unlike you, there's a glass. I'm going to make a bold prediction. So recapping on the immigration job side. My bold prediction, there will be a bipartisan bill passed this year that secures the border while at the same time expanding the H-1B visa program.
That is bold.
Yeah.
Yeah,
Yeah.
it's bold. It's bold to say bold and bipartisan in the same
How
statement.
about it?
All right, I'll close this out. So
Jesse, yeah.
I know I kind of hit on it when I spoke before, but I think what my baseline would be from a rate standpoint is that we're going to see maybe one cut as a baseline, and then my bold prediction would be that there could be rumblings of rate hike, at least a rate hike, and it's gonna cause chaos. Having said that, though, I do want to review that there were two things that I think came to mind as I was just listening to everybody talk about their different subjects. I spoke of unexpected impacts to fiscal monetary policy. One that I do want to shine light on when we think of federal student loans. So we do know that delinquencies are going to be reported now on those student loans. They're coming through sometime in the late early February to mid-February timeframe. And as I said before, that's what I think we can't predict necessarily in terms of building that through to what happens with rates, but something like a higher level of student loans and the turmoil that causes, like that's I think where the Fed may have to pivot from that one cut that I mentioned. The other thing I would mention, we've all kind of talked about affordability, but one that comes to mind is insurance right now. Certainly housing, insurance on housing. It was already challenged, let alone now what happens with some of the tragedy we've seen on the West Coast. So, just kind of throw that out as when we think of unexpected events, they're gonna come up. We know they are, and we just have to kind of size them, see what the impact is, and then figure out how that impacts both the consumer and the economy.
Thank you, Jesse. You wrapped us up very nicely with other key topics to keep in mind. Thank you again, Jesse, Dave, Emmeline, and of course, Tom, for joining me today. To our listeners, I hope you enjoyed today's topic. How do these predictions align with your expectations for the year? And what are your predictions for 2025? If you would like to share these with us, or have questions or suggestions for future podcasts, please reach out to us at riskadvisors@equifax.com. We would love to hear from you.
Yeah,